disent vraiment je connais rien à rien, je commence, ça m'intéresse. OK? 4 personnes. Intermédiaire, un bon 5 personnes. Puis ceux qui... What's up? There's nothing in French tonight. I can speak you in French, but as the event is going to be in English. And then who are the advanced people who know their stuff, you know? Like David. All right. Okay, so for the beginners, if you have questions, this is like kind of networking questions. Like this is not for our host here. So I need to take my phone to present you decently, Matthew. So Matthew Finestone, so you are business development director at Loopring. You will talk about Ethereum. We'll talk about decentralized finance, or the so-called DeFi. That's kind of a new one for me. And of course, you're going to talk about your business, Loopring. So very cool. Just before we start, give me about 5 minutes, and we're cool. So first, I want to thank the Desjardins Lab. So officially, there's no one representing them tonight. So they allow us to do this event free. So this is free for you, free for me. So a big clap for them. So thank you very much to welcome us. They have a great setup. And we're going to talk about, let's say, stuff that challenge them, and they welcome us. So I really respect them for that. And then I want to... je veux remercier les gens qui m'accompagnent ce soir dans l'événement. Donc, des gens qui sont là depuis les premières heures. Donc, il y a Tamara ici qui a organisé l'événement, qui a fait le contact avec Matthew. Donc, Tamara, merci infiniment. David, you're helping me, so very grateful for that. And it looks like you bring us some how do you say it? Not gimmies, but some food to eat. So we're gonna have, sorry, man. So we're gonna have some break with fun food. Well, the mission for Crypto Montreal, the first one is to democratize the subject of cryptocurrencies. So today, yes, it's not for beginners, but we have beginners even as well. So check out, follow us on my blog, pascalnd.com, or on Meetup. The second one is to reunir or regroup people who are enthusiasts. So basically, I consider myself an enthusiast, not someone who is like all in one project, but I'm really open to every project like yours at Loopring. And then I hope you're gonna take time to know someone tonight that you don't know. So this is the third mission of Crypto Montreal as a meetup. So I want to encourage triads, we say. So let's cheer up, let's have fun, let's meet someone you don't know, and I'm sure you're gonna grow out of that. So this is it. This is your show now. So please welcome Matthew Finestone.
Thank you very much. Is the mic okay? I've never used such a high-tech mic before, so just want to make sure. All right, great. Perfect. Thank you, Pascal and Tamara and David and Adam from Digital Privacy Montreal for also helping to promote it. And thank you all of you for coming. It's really awesome to be able to speak to you about this. I'll start, I think this will be maybe intermediate level. We'll start by just a brief overview of Ethereum, which we will need to start with Bitcoin before that just to really appreciate Ethereum. Then we'll talk about DeFi, decentralized finance. There's a whole lot of weird abbreviations in this space, so here's our little legend. DeFi, decentralized finance, DEX, decentralized exchanges. You could tell the theme of decentralizing everything. So let's jump right in, and maybe I'll skip through some stuff if it's too beginner. So first, let's just discover like why we care about crypto in the first place, and let's look at Bitcoin to start. Digital scarcity, right? That was never a thing. I was never able to own something on the internet that is provably mine and not yours and can't be duplicated, infinite times. So digital scarcity was one of the big innovation of Satoshi Nakamoto, and that was Bitcoin. 10 years now, we've discovered digital scarcity, and I think it'll change the world. I'm sure some of you guys would agree. The second thing, which is really cool in my opinion, is you can't kill it, and nor can any government. It's permissionless, censorship resistant, immutable. So permissionless means anybody could partake in the network. Anybody could use Bitcoin. You don't have to pass any checks, any identity checks. It's permissionless. Censorship resistant means that the government, really a sovereign level actor, cannot censor you. If you want to send money to somebody or write to the Bitcoin blockchain, it is your right to do it. It's nobody could censor you. And immutable means once it is written, and with a few caveats, but once it's written and then a few blocks have progressed, it's immutable. You can't go back and revise history, change history. So while Bitcoin and crypto means different things to different people, like these are what's important to me. It might not be the same for you, but this is what a public blockchain, why it's interesting to me, these properties. And yeah, a lot of other things make it interesting to me as well, but we could talk about that another time. So Bitcoin is good money, and money is, and this is important for later, anything we say it is, really. I find like education about money is maybe one of the biggest impediments to people just appreciating Bitcoin, because they say, hey, we have perfectly good paper money or other sorts of money, and they don't like see the virtues of Bitcoin. But really, money is anything we say it is, and I have a few of my favorite sayings up here, but it's a social thing, money. It's a social technology. It's a social pact. It's just an agreement. Specifically, if I believe that you believe that she believes that this clicker is money, then it's money. Like, it's that simple. Throughout millennia, we just have changed what we use as money. Some things are good money, some things are bad money, some things are the best money. But money is just a social thing, if we agreed. So it's literally evolving as we speak. What is money? And to some people, you could say that it's a meme. It's a cultural thing. It requires a cultural understanding. And like a brand, right? Brands are just like shortcuts to understanding and trust. Bitcoin is a brand, just like US dollar is a brand. And let's just look at what money has been. Those are the famous Yap stones. This was literally money on certain islands. I'm not sure the exact time frame, but people would ascribe that to him, and that's your stone, and it was hard to reproduce, so it was money. Beads were money. These were called trade beads. Gold was money. Now we have paper money. In some cases, it's good. In some cases, it's really bad. And trust. No one is what this is all really about. And I don't mean to sound like a paranoid person, but with digital scarcity, we don't need to trust a centralized party, that's not a government, not a bank, to keep tabs of our money. We could all do it ourselves on a public ledger. And we do this by trusting code, which to me is much more trustable and reliable than humans, but also what's kind of pushing the code forward and why we all agree to trust the code is because we're trusting just human rationality. We're just trusting that you want to look out for your own best interest. And specifically, greed. A lot of this is really just, if I think that you're like a rational economic actor, then Bitcoin and these systems will work because it's kept in place by people just looking out for themselves. So we'll move on a little bit from here, unless we could go back to this later during the questions or anything. But so Bitcoin, it's difficult to print. It has 21 million units. It's by proof of work that it comes into existence. Proof of work just means that it has to be difficult to be printed. It has to have a certain level of work that's required. Otherwise, you could just, arbitrarily print it. And we could go into this later because we'll get into Ethereum right now. So,
is there any reason for 21 million units max?
Yeah, that's a good question. And no, it's a completely arbitrary number. Satoshi Nakamoto chose that number. Maybe it was significant to him or her or them, whoever Satoshi is. but it doesn't really matter, but now it's taken kind of like a holy place in the social consensus, in the social pact of Bitcoiners. 21 million is a holy thing. It would be sacrilegious to say, let's go to 24, because that's a better number. But really, the units doesn't matter, specifically because Bitcoin is divisible up to, like the smallest unit of Satoshi, like 9 decimal points. So it's sufficiently divisible. What's important though is that like there's a number that everybody looks to and agrees on. That's the social pact. If for some reason it was 18 million, we would still be here talking about 18 million. It wouldn't matter. Yes, please.
Question. So based on the trajectory that we're on with Bitcoin, the 21 million units for Bitcoin is not the same as 21 million units for Zcash, for example, because they have a different initial point. You could renormalize your algorithm to equate them. By virtue of that, we're closer to the threshold with Bitcoin than we are with Zcash. Is that your argument? We could easily renormalize our quantities. They're arbitrary. What's important is the specific trajectory and the difficulty algorithm and how it's set in order to achieve
right.
mineable units.
Yeah, I think I would definitely agree with that. What's most important is just like the credibility that number will stay that number. And back to me believing that you believe, that she believes, that we all, in economics or psychology, like a Schelling point, we all gather our attention around one very noticeable thing. 21, that's what's important. So you're right, but what's important right now is the credibility that this will stay, this monetary policy. And right now, so every 10 minutes a Bitcoin block is mined, and there's 12.5 Bitcoins given out to the miner as a reward. That equates to like a 3.9% inflation rate today. It'll go asymptotically to 0. The last block will be mined in 2140. The fact that I could look at that, and that seems like that is like a natural law almost. It's like gravity. The fact that I could look to that and it's not going to be changed by a couple Federal Reserve Board members every 6 Wednesdays, then that's what's important. So I would agree with what you said. Of course, similar to your point, you could fork it and then have double the coins, but then
that's the only problem.
That's a problem, but it's also just easy to be like, no, that's not Bitcoin. It's like a fancy car or a fancy purse. Somebody could duplicate it, but it doesn't mean that it's going to achieve the same level of. But I agree with what you.
I would argue that it looked like Bitcoin, ABC was going to become Bitcoin at one point. Early on, the early stage of the fork,
right. I don't personally believe that, but for sure, there's different factions. Yeah, right. Yeah, no, it's a fair point. So let's get to Ethereum. Perfect timing here. So what makes Ethereum interesting is everything we just said. It's all that digital scarcity and permissionless, immutable, censorship resistant, plus the ability to execute arbitrary code and programs and apps. So if Bitcoin was just concerned with being like the best money ever by being scarce and open and nobody could mess with it, Ethereum does that, but then allows you to build on top of it a whole bunch of different use cases. Specifically, here's a definition, and it's hard to just put into one little box, but it's an open source, public, blockchain-based computing platform with smart contract capability. The smart contract is the important thing here. Ethereum is called a smart contract platform because you could, just like a contract, you could like enter an input, the contract says how to treat that, and then you have an output or an outcome. And that is what happens on Ethereum at the code level. These contracts execute, and the whole world could use this computer as like a neutral computing layer. So, and actually yesterday was the 5-year anniversary of the Ether private sale. So 5 years in. That's not when it launched, but that was a private sale. So anybody could build a dApp, which is an application that we're all familiar with on our phones, except it doesn't live in Apple's little store that's a walled garden that they have the safe for. It lives on Ethereum, which, as we said, anybody could use. And it inherits those strengths. So we have a new base layer of a digital economy, and this is where we're going to go with DeFi. And the promise is that anyone with an internet connection can access these services, these products, and dApps. And finally, just to reiterate, it's trustless. We don't need to trust middlemen or third parties. We trust, similar to Bitcoin, human rationality, economic interest, and greed. So Ether is the native currency of Ethereum, just like Bitcoin is the native currency of the Bitcoin blockchain. It's the gas that powers the network, and it incentivizes the people that actually participate in executing the transactions and keeping the state of this computer. They get gas, Ether, for their efforts. We'll go back to that in a bit later. So Ethereum has become a really thriving community. It has the biggest developer community by a big margin, a very active normal community that's beginning to encompass a lot of finance people, legal people, etc. And all of this attention is really spinning out some network effects that app is very interoperable with another app, and they could all speak to each other. And we call this composability, meaning if you build something cool, I could build on top of it, and I could interact with it. And that's why, in my opinion, and I'm definitely a big Ethereum fan, I'm a big Bitcoin fan as well, but Ethereum has this great flywheel of composability leading to more and more benefits by working on each other's previous efforts. So finally, let's just look at a few of how Ethereum has evolved in terms of memes. Why is Ether valuable? Why is Ethereum valuable? Why is it going to persist into the future? We used to call it a world computer. Then it became, in the boom of 2017, it became the reserve currency for funding ICOs and tokens. So people would raise a new token, including Loopring, which we'll get to, and instead of accepting dollars, because we would live, our tokens, 95% of tokens live on Ethereum, Ether would be the funding currency. So it became super valuable for that, and of course it famously reached $1,300. DeFi came, oh, please.
1,400.
What's that?
It reached 1,400.
1,400, all right. Did you sell the top?
I certainly did. Actually, I think 1,600, the average on the exchange is 1,000. There's one exchange where it
Right.
was okay, it reached 1,600.
Right. Interesting. DeFi, which we're about to get into right now, decentralized finance, has been a strong meme for Ethereum. And now, related to DeFi, it's programmable money. People call it money Legos. Somebody on Twitter calls it that. Well, I really like that term. It's, money, composable money, like money Lego. I really like that. And similarly, programmable store of value. That's been a strong meme these days. So this is just to show you kind of like the evolution of what people think is Ethereum. And to be honest, a strong narrative is important. It's important for people to say, oh, I like Ether because of DeFi, or because it's, programmable store of value. So these things are actually important. Memes matter. It's quite incredible. So I want to look at ETH progress, and we're going to look at some Twitter snippets here, because a lot of crypto kind of unfolds on Twitter. If you're not aware, crypto Twitter is a real thing. But so it's talking the progress that ETH has made since March 2016. There's $500 million locked in DeFi. There's progress on ETH 2.0, which we'll get to. The resolved identity crisis, that's what I just said. It's like, oh, what is Ether? Now people are calling it programmable store of value. Institutional adoption coming in the case of futures. We have UX improvements, layer 2 progress, which is scalability we'll get into, and the community maturing. So the future is bright. This is just to give you a sense of what people care about deep in the community right now. It's these things. It's the progress, how much money is locked up, and stuff like that. And I quite like this, and this really will lead to our talk about DeFi. Ethereum is quietly becoming the global platform for every asset. You have securities going above, debt, game assets, licenses, digital shadows of physical objects. That should be digital representations is another way of putting it. Ethereum tokens and non-fungible tokens, insurance and synthetic assets, and Tether and other custodial fiat, like wrapped dollars and stuff like that, and wrapped Bitcoin. So this is everything. This is what people are using Ethereum for right now. And I quite like this to sum it up. This isn't about being dominant in any one category. It's about slow, relentless accumulation of network effects as assets of every type start being traded on the same censorship-resistant global computing platform. So you definitely see a theme here, how Ethereum is kind of said to be becoming a black hole, swallowing up these use cases and other assets, whether they're digital or physical. And the key word here being traded, because that's where Loopring comes in and other DeFi projects. So we'll go. The final thing I want to talk about before getting into DeFi is just the monetary policy of Ethereum versus Bitcoin, actually. It's, sorry, is that a question? No, sorry. It's something that interests me, and I think it's instructive to look at the differences. So we spoke about it. Bitcoin has a fixed supply, 21 million units will ever exist. Right now, it's being printed or issued, rewarded at 12.5 per block every 10 minutes. That's a deflationary currency because it's fixed and it can only ever go down after that point by losing, burning, etc. Ethereum does not have a fixed supply. There's no cap. It currently is being issued at 2 ETH per block, which is about every 15 seconds. And we call that a disinflationary monetary policy because assuming that 2 ETH per block goes on forever, as a percentage of the existing supply, that'll also asymptotically go to zero as 2 ETH becomes a very small percent of the existing supply. So you see the difference here. This is like a kind of very rigid consensus around 21 million. This is not set in stone. Ethereum kind of believes, all right, we don't know what's exactly best. We have an idea. Of course, we want issuance to be tame and kind of sensible because as a store of value, you can't just have a huge amount of new money printed. That's to a large degree what this is about. But it's really decided by the community in a dynamic fashion where Bitcoin, it's quite simple. Everyone just looks at 21 million and they say, that's it, we're never changing. We could have an interesting discussion after the fact about why that may or may not be true. Because when block rewards stop in the year 2140, what is going to incentivize miners that are doing the work, literally burning electricity and buying expensive machines to keep the network secure? If they don't get that 12.5 Bitcoin reward, what's in it for them? The answer is transaction fees, which every transaction has to give a little piece to the miner to incentivize them, but will that be enough is the point, and that's a big argument. So Ethereum stays more flexible and says we're going to figure this out, and there's no like set way of figuring it out. It's just, okay, core developers, what do you think? Teams building on us, what do you? It's an informal process. So,
Thank you.
yeah.
When Ethereum moves to proof of stake, or rather if ever, will this change? This inflationary will be?
Right. So very good question. We were going to get to that in like 2 slides. So good question, Tamara. If the slides don't answer it, I'll try to answer it. But so just back to Twitter for some. This is actually some comic relief here. So he says, this is an Ethereum fan. Did you know it's likely ETH issuance will drop below 1% before Bitcoin does? To which a Bitcoin maximalist says, did you know ETH is a worthless shitcoin? So this is just to show the dynamic between the takes on the monetary policy. And then a Bitcoin maximalist, and I don't say that in a derogatory way, they're just, maximalists for Bitcoin. Did you know with Bitcoin, you don't have to speculate about the issuance rate because it's been decided when it was created and will never change. That's that kind of shelling point that's easy to circle around. Which is, like, that statement is true in and of itself, but and this is an Ethereum maximalist or guy, a part of the community, and this starts to answer your question, Tamara. The remaining major events for Ethereum issuance to approach less than 1%. So today it's 4.5%, which is kind of like Bitcoin, which is 3.9-ish. So it's about the same. In 2020, it actually goes up a bit because, so Ethereum 2.0 is coming, guys. I'll get to that in 1 second. But you see, so it goes up a bit, then it goes to 1.5 in 2021, and then finally, like the steady state should be less than 1% as it's a full proof of stake blockchain. So you see that there is some, some hint at consensus evolving around this. People look at this and they have a sense, but it's not set in stone. There could be delays, there could be slight tweaking of the parameter, but there is, and this is, yeah, please.
This means that inflation rate on Ethereum Classic will be always lower, or starting in early 2020 will be lower than Ethereum, the main chain.
On Ethereum
Classic, because they don't go through this
right.
This transition to proof of stake, and therefore their
right.
inflationary rate will keep on falling, and would that mean that they will always be lower?
Well, not always lower. So this is a temporary bump because actually, like ETH 2.0 is going to exist in parallel as ETH 1.0.
Oh, okay.
It's not like ETH 1.0 is going to like just deprecate or die. It's like, so you're going to have ETH 2.0 and ETH 1.0 proof of work and proof of stake existing at the same time. That's why there's a brief bump. Okay. But like, let's just try to avoid that for a second. The steady state and forevermore should be lower. As far as Ethereum Classic, that's completely unrelated to this. I don't follow that space much, or that chain much. I don't know what they plan on doing. But
this metronome is very important. They're trying to
metronome.
They're trying to connect the two blockchains.
Right.
They're trying to have an inter-blockchain interface that makes the tokens transmissible, which is very interesting. And that bump that you're mentioning would have an interesting impact on it.
Yeah.
That they've been trading very separately lately, but metronome would bring them back.
We need to continue with the talk, right? So let's have.
Well, definitely. Thank you, though. We'll get back to that for sure. Okay, so ETH issuance. We'll move back past this now for a second because we're going to get into the DeFi. But yeah, and tomorrow we could speak, but you'll see like the steady state is meant to be under 1% on proof of stake. Right now it's 4.5%. It's meant to be under 1%, which does lend itself to a more scarce currency and more store of value expectation. And these are in 2.0, depending on how much is being staked. So just very briefly, Ethereum is heading towards a massive update, which is ETH 2.0. And the biggest thing of that is that consensus, or the kind of rate limiting factor, will be proof of stake, where people are limited in their say of the system, not by their hash power of how many miners they have plugged into the wall burning electricity, but how much stake they have locked up in Ethereum. So instead of your say being coupled to your kind of machines, it's coupled to your stake in the system. And depending on how much ETH is validating the chain, you have different max issuances, which corresponds to different rewards per validators. Perhaps a bit tangential to the rest of our discussion, but as we see, so proof of work is going to proof of stake, miners will become validators. The potential benefits, and these are potential because it's rather experimental, less centralization risk because only certain people are able to become very efficient miners in very competitive proof of work schemes. You need cheap electricity, lots of space, and other things. More, on that note, more energy efficient and more secure in some instances. I don't say this with huge conviction because it's still a bit uncertain, but one way of thinking about this, in Bitcoin, if you misbehave as a miner or kind of don't act optimally, all you do is miss out on the block reward. It's just, you miss out. In ETH 2.0, as a validator, if you have staked something and you're trying to validate the system, if you misbehave, you could be slashed. Your stake could be burnt, removed from you. So that's like a different degree of negative incentive. Whereas Bitcoin is just like, okay, you miss out. In ETH 2.0, you could be slashed. So you best act optimally, or how you said you will. And sharding and a few other things we will get into after. And just to show that it's not all bad blood between Ethereum and Bitcoin. So we see a few things that the communities agree on. Unstoppable money is vital. Decentralization is essential. On-chain governance is a bad idea. privacy is important, VC tokens won't be money, and Tron is absolute trash. And I won't condone that last statement, but because I don't want to be mean to any projects. But yeah, you see, this goes back to our first few slides. Like unstoppable money and decentralization is essential. Any token that kind of makes, or blockchain that makes compromises there, whether it's for throughput or some type of functionality, to me that's just a lot less interesting. Those first two are the most important. So now we'll get into DeFi. Unless you think we should take our break now, and we break now or after DeFi?
Do we want to eat now or not?
No, we want to walk in.
After?
Later.
All right, let's continue.
Okay. So decentralized finance, open finance. There's actually a bit of a battle between what's the better name, but DeFi has been winning out. It's been a big use case of Ethereum. As we said, it's been one of the driving memes recently. And what it is, it's supposed to be financial applications and services that are built on top of these completely open networks. So it's financial services for anybody. No censorship because you're that type of person or because you live there or because I don't like you. It's just open finance. And here are some of the characteristics or buzzwords, but they are important. So it's open, permissionless, censorship is transparent, meaning I see where the money is. There's no opacity or anything like that. It's immutable again. There's no counterparty risk. I'm able to kind of trade with you without having to trust you for like 5 or 10 minutes while you get my assets before I get yours, something like that. It's programmable, meaning we could write the code and we expect it to perform a certain way, and it will, hopefully. It could self-execute, and please.
You mentioned something about trust.
Yeah.
So I think the trustlessness, the concept of trustlessness has to do with trusting the entire system day by day, week by week, month by month, year by year. But you still need to trust who you're dealing with on a 5-minute basis. Because if you send them something and they don't send you what you expected, or if the product they sell you is no good, you're still in a trusting relationship. You know what I mean? So the trustlessness has to do with the core system, because in theory, in the future, all the banks could be, they could suffer a problem and they might tell you your money is no longer available. I'm just saying. So, I mean, do we trust the banks?
Right. You're talking legacy banks or like banks of the future built on Ethereum, let's say?
Legacy.
Yeah, legacy, no, I agree. That could happen. But, I mean, we're lucky in Canada. We have like maybe the best regulatory regime of banking in the world along certain lines. But there's certain countries that, yeah, you'd be unwise to trust the banks for sure. But yeah, on that 5-minute basis, absolutely.
You still need trust.
But on Ethereum or
to transact with someone, you have to trust them.
Right. But that's why, that's a seemingly small problem that I have to trust. Hey, here's a clicker. Now give me $5, and you just ran away with the clicker. But on Ethereum, and by virtue of these smart contracts, the property of atomicity, which is a fancy word of saying either both things happen or neither. So it's like I put my clicker or the representation of it in escrow. You put your $5. If your $5 doesn't enter that escrow contract, then I get my clicker back. So there's no risk. They either execute or it fails. So that's exciting to me. That's what a lot of this decentralized exchange is exactly about. It works or it doesn't. Nobody could run away with your money. And composable. That's that interoperability thing we said, how your product could speak to mine. There's no walled gardens anymore. So a lot of these, DeFi has very lofty goals, really. Banking the unbanked is what a lot of people say, and it sounds like a very noble mission. We're going to bank the unbanked. Anybody with a mobile phone is going to have access to the same financial services. But the cynic in me, or the realist, and again, I'm obviously a huge fan of the space, and work in it. In reality right now, it's just really unbridled speculation, margin trading, earning interest. That's what DeFi is right now. We're not exactly banking the unbanked. We are kind of just speculating. And in fact, a lot of this it leads back to people going leveraged long ETH. So ETH fans are building this system. Whoops. and it becomes a way for them to actually just like put in some assets and go levered long ETH. We can get back to that in a second. But here is actually something that came out yesterday from DeFi Prime. This maps out the decentralized finance space. And you could see, maybe it's something that you guys haven't heard of much, but geez, what's going on? It seems to be a pretty, it's an industry already. And we have different categories. Loopring is right here in the infrastructure component, which we'll speak about that after. But you see that this DeFi has really captured the imagination of people. And I should say, this isn't like exclusive to Ethereum, but this is really predominantly based on Ethereum. I actually didn't do the math, but like DeFi is effectively, or at least the perception is, an Ethereum phenomenon, although it is kind of seeping into other chains. But the developers are, it's really an Ethereum main driver. So just to look at some of the categories, we have asset management, prediction markets, identity, marketplaces, lending, asset tokenization, exchanges, staking, stablecoins, insurance, derivatives. So you see this parallel financial system is being built. We're in Desjardins Labs here, and it's just so interesting that a bunch of companies that maybe not a lot of people have heard of are building a parallel financial system. So you see that it's growing fast, and one way that it's measured, and it's not a complete measure, is how much value is locked in some of these products. And that is usually Ether, the native asset of Ethereum. There's $500 million locked in these types of products right now. And you see it's growing. It dropped here. This is a bit misleading because it's the US dollar value of Ether. What would be more instructive is looking at just Ether locked up, because then you don't have the dollar affecting the trend. You'll see, though, a whole lot of it, 330 or 67%, is in Maker. Maker is leading this DeFi movement. And so MakerDAO is something that's super interesting. It's a protocol for borrowing in some sense, but a byproduct of the borrowing is the existence of a stable asset. We all know that Ether and crypto, people talk about how volatile it is, but the Maker system allows you to put in Ether, withdraw less dollars that is backed by that Ether. So you put in, let's say, $150 worth of Ether. You could draw 100 DAI, which is a stable coin worth pegged to $1. And then you have a stable medium of exchange that could be used in the DeFi system. So I won't spend too much time on that, but just to show you the trend is growing. You have a few leaders in the space, but yeah, it's growing fast. You can't really see here, but this is just to show that everything that happens is transparent. I don't need to worry about are the transactions actually happening. This is at the smart contract level. I can see exactly what's happening. This is on Kyber network. This is a DEX, an on-chain DEX protocol. DEX volume is going up. 300 million was traded last month in June. That's up from 86 million.
Matthew, I think you should say, what is the DEX?
Oh, good idea. Well, that was on the first slide, if we all remember, a decentralized exchange. And yeah, good point. A decentralized exchange, and it's kind of what I just said with David, it allows us to exchange in a way without counterparty risk for the most part. So that whole problem of me giving him something first, then he runs away, or us having to, let's say, trust Pascal. I don't trust David because I don't know him or...
Can you use an example of a fictitious person?
Yeah, sorry.
Over there?
Yeah, Adam.
No, behind the transparent...
Yeah. So I don't trust Adam, okay? But we want to make a trade of, token A for token B, or clicker coin for whatever. Usually it's like, okay, one of us has to bite the bullet and say, okay, Adam, here is your thing. Now please send me my thing. I'm sure you all are aware of this. If you have to buy tickets from somebody on Craigslist or something, you're trying to buy tickets for a show. You're like, are these real or not? And they say, okay, give me some of the money, and then you don't get the tickets. A historic solution is we trust a middleman with reputation or like business risk. We have the Bank of Pascal, let's say. Can I use you as an example?
Sure.
We have the Bank of Pascal who has like a big building, and like we trust him because he's put a lot of effort in building his business. So we say, okay, here are the tickets, here's my money, now give it to the opposite person. And you take a 3% fee for doing that. And it's great because we don't have to trust each other. We just all put our trust in you. A decentralized exchange says, forget the middleman because you could be corrupt. You could run away with both our assets in the middle, or you could charge exorbitant fees because you're the only service in town. There's tons of things that could happen. Or you could actually be a good guy, but as you have our assets, you get like regulated because you did something wrong elsewhere, and the government shuts you down, and we're just unlucky and we lose our assets because of that. All sorts of things could happen, right? This is all about like kind of not trusting middlemen. So with a DEX, we just deposit our assets into an open piece of code, let's say. I'm not trying to make it so simple, but we just interact with an application that we don't have to trust anybody. Adam's assets go in, my assets go in at the specified exchange rate or price, and they disperse to the opposite person. We bypassed you, we have no risk. All we're trusting is Ethereum to continue executing the code that, again, is verifiable. We're not trusting that it's, of course there could be a bug, that's the risk. There could be bugs in these things, but they're audited and there's bug bounties, and the more they exist, the more we have faith in them. So that's what a DEX is. A better word, like decentralized has lost a lot of its meaning, in my opinion. Decentralized, like what does that all mean? Non-custodial exchange is the way to think about it. We don't give custody to the Bank of Pascal to trade. We trade non-custodially. We keep, or self-custodially. So moving on. We'll get back to DEXs a bit later, of course. So DEX volume. So here I just have some stats. We don't need to dig too much into it. One thing I will say is, so you see the volume in ETH, which is a better representation. It hasn't grown that much. That's looking from, over a year ago. It hasn't grown that much. DEXs, we'll see why. There's still some problems. And also, look at the traders per day. Here I took 2 days ago. There's only 2,700 people that traded on all DEXs a couple days ago. So it's still very nascent, even though this is a big thing. But we'll see why it's still hard for normal people to trade on them. Yeah, very good question. So I think if you were to look at like coin market cap right now, you would see around, in terms of volume, I don't know number of traders. That's a very good question. The only thing I could approximate is by dollar value, because that's the thing. Centralized exchanges are centralized, and behind their closed doors, I don't have the benefit of being able to see. All I had to do to get this data, or the site that did it for me, and I'm sorry I don't have like attributions here, they're in my notes. This is a site called dex.watch. This is a perfect example. You asked me a question, I would love that info. I can't call Binance or Coinbase and say, how many traders did you have yesterday and 2 days ago? They're like, who are you? Hang up, right? Like, we don't want to do it. Here, all I had to do was look at some contracts, some public smart contracts on Ethereum, and it's very transparent. I aggregate them, and then I have my view. So that really is a good demonstration of it. Yeah, sorry, please.
So to add to that, if maybe sell decentralized exchanges a little more, there was a report that came out a few months ago that said many exchanges were faking trades and stuff like that. So in that report, you might find for some of the more honest exchanges, the number of traders, but overall, a lot of decentralized exchanges faking.
Right, exactly. Very good point. That was an interesting report, and definitely does help to sell DEXs. But just so we could kind of approximate the scale we're looking at, I think right now, daily, you see like $60 billion traded on centralized exchanges, okay? $60 billion. What's your name, I'm sorry? Justin's point, that report came out, said roughly 1/10 of that is true. So let's go from 60 to 6 billion. On DEXs, this would equate to about, at $200 per ETH, to 20, it's about 6 million. 6 million. So 1/1000th of 1/1000th of the volume on centralized exchanges of DEXs. But so 60 billion. Yeah, those are the estimates. Some people say it approximates 1%, depending on if we trust the centralized exchange volume or not. But yeah.
Okay, well, another thing, I don't even trust that report because they weren't basing it on API usage. It was just based on website usage.
Right.
So,
For sure. Yeah. No, you're absolutely right. I don't trust that report either. How far we discount it, I don't know. But that's the thing. I can't answer this question. That's the problem.
60 billion in Ethereum alone?
No, 60 billion in crypto trading volume.
Trading. It's just Ethereum.
Yeah.
The Ethereum is about 2 billion a day.
Right.
On crypto compares.
Right. Sorry, I just meant all of crypto trading right now across all exchanges is like 60 billion. I'd say between 50 and 60 billion. This.
Do we assume the same ratio there in terms of volume to trade? That the average trader is trading about 10 Ethereum tokens per day? I think they're going to be bigger.
Bigger, I'd say.
Probably 100 to 1, right? That's more likely.
I'd say. I don't know what my basis is for that, but I would say that. But really, this doesn't mean that every trade here actually happened in ETH. It was just normalized to ETH. As you can see, ETH is becoming like the unit of account here. This could have been DAI to BAT or any tokens, just they're taking the Ether value. But really, actually in practice on decentralized exchanges, ETH is the quote currency of a lot of trading pairs. The same way we all look at Canadian dollars, a lot of things look at ETH as the quote.
If we use 100 to 1, we get about 600,000 traders on the Ether.
Right.
Ethereum below.
Yeah, so moving on from there, this was very interesting though. And just to say, I won't dig into this. Is from Total, which is a DEX aggregator. There's a whole spectrum of how much trust you place. You have the complete centralized, where we're saying with Justin and Tamara, we have no clue what their numbers are, and when they have your assets, they could run away with it. That's the problem, guys. By the way, we haven't really discussed it. When I want to trade on a centralized exchange, I give it to Binance.com, or I don't mean to pick on them, they're the biggest and one of the best, but when they have my money, they could run away and steal it. That's why decentralized exchanges are a thing. I am my own bank. They can't steal my money. So there's a whole spectrum. There's different types. I'm going to fast forward through this for now. This is from a report from Delphi Digital. I'm going to go through it. These are just some usage statistics, but I want to get through this just because I think you guys are hungry and thirsty, and then we could dive into this a bit more on the Loopring front, just to show which DEXs are being used. So MakerDAO, just to show you, when we saw how much money was currently locked up in Maker, the biggest protocol in the DeFi space, the percent of ETH that is locked up in just that one protocol is 1.37%. That's a pretty good chunk of ETH that is literally locked. It's not locked indefinitely, but people put it in there so they could draw out a loan against it in DAI, in a stable coin. And I'm sorry if I'm going over this too fast. I'm definitely happy to go into Maker a bit more after. It's very cool. But you see, there's 1.5 million Ether locked up in the MakerDAO smart contracts. So you see how very quickly, and we're just in the early innings of this, very, very quickly, you see how DeFi use cases are just gobbling up ETH. And we could talk about this a bit later. One thing, a cool exchange that has really captured the imagination of people lately is Uniswap. And this was cool because it wasn't a big project or a big team. It was one guy, and he deployed this contract, and it's very simple. It's just a swap. It's not even like a full function exchange. It's just a token swap service. So if I want to put in 0.01 of an Ether, I say, how much LRC could I get? LRC is the token of the native token of Loopring, which we could get into a bit later. And it says, okay, you give me 0.01 Ether, I'll give you 54.8 LRC. That's the exchange rate. And again, I don't have to trust Uniswap. Uniswap is faceless. It's ownerless. It's just a contract that lives on Ethereum that some guy deployed and then stepped back, like destroyed the keys that could control this. And now, so if I send in 0.01 Ether, I know for sure I am getting this. He can't steal my money. He can't mess with me. There's some technical things that could happen, but overall, I am getting this. So this has been a really cool project, and a lot of people like it just because it meshes well with the ethos of Ethereum, of just not a huge, a lot of people kind of taking fees and stuff. It's just a simple interface. And just one more quick example of a big DeFi project, or one that I quite like. InstaDApp is kind of aggregating different protocols and providing you almost like a unified interface. So it's like, imagine you went on your phone and you saw the value of your home, plus the value of your car, plus the value of your interest in like your friend's private company, plus and you could use all that money in one pool, and you could borrow against it and lend against it. Of course, that kind of seems feasible, what I just described, maybe, but if it's at different banks in different countries, you can't really work together, right? Like if you have a loan that's like a mortgage from your home, but then you want to use some of your interest in a friend's startup to maybe take some equity out, nothing works together. It's all trapped in silos. So InstaDApp allows you to lend, borrow, leverage, and swap across several different protocols that it integrates. And we could talk about that later if you'd like. And you see, like, this is what the dashboard looks like. So you have this much borrowing power, and it's connecting these separate protocols. So it's just such a, back to the word composable, all these things are, dovetailing with each other and making really a parallel financial system. One thing that's also really cool, again, back to the transparency, there's so many things out there. I want to know the best rate. I don't really care. I want to sell 1,000 DAI, which is that stable coin I mentioned. Where's the best rate? Here's a site called Dex Index, where it's going to present me the best rate. Okay, here you can get 4.58 and all the way down. So that's the best, that's slightly worse. So you just see how transparent everything is. Like we just said, we couldn't even answer a few simple questions in the centralized way. Here, everything is so transparent. It's like, when you're looking for the best price in like a shopping app, this is just all the info is at your fingertips. Similarly, this is called Loan Scan. The same way I just looked at which is the best rate of trading here, this is showing me the best interest rates. All these different protocols are borrowing and lending protocols. So I could see on Loan Scan, okay, my best place to earn DAI would be on Compound. I could earn 17.75% there. So again, it's just everything is so open, and if I want to earn that money, all I have to do is literally send it to their contract, and in 15 seconds, I'm starting to earn that money on a block by block basis. I will literally be accredited or credited my interest every 15 seconds versus monthly or yearly in a normal bank. Now let's just talk briefly some obstacles before we could eat and drink. So it's hard to interact with. For those of you that are familiar with private keys, while it's nice that I have control of my own money and I don't have to trust anybody, it's also scary. If these are my private keys, what if I lose them? How do I recover them? Of course there's ways, but it's not simple, and it's not a good user experience yet. We're making great progress, but it's hard to use. Centralized products, all else equal, are much easier to use because you're outsourcing the difficult trust and authentication to a trusted third party, but at least they're doing it for you, and you don't have to be so cognizant of the risks. Then there's regulatory and legal risks. Like, imagine Uniswap. They deployed that contract. Now they're making all these trades for people all across the world. What if the US says, hey, stop that? Remember, one of the features I liked about this is that it's unkillable. It's just a contract that lives on Ethereum. The weak link is the interface, literally just the website where people access those contracts from. The US or some powerful adversary could go in and shut down that website via the DNS and stuff like that. There's ways to go around that like there's the ENS now, Ethereum name service. But there's regulatory risks. Who's this for? Product market fit. As I said, we have lofty goals. We're trying to bank the unbanked and everything. But right now, people are really using this to speculate and get more exposure to crypto risk. It's difficult to link real-world physical assets. Maybe some of you picked up when I was giving this example of doing the clicker. How does it work with the clicker? It's easy if it's tokens, one token for another, and it goes into the contract, and then you give it to the opposite person. How does it work with a clicker? Who's to say that after I make the trade with Adam, that I don't smash this clicker on the ground and tape it up and say, here's your clicker? Linking things to the physical world is a difficult thing. And really, to me, the biggest problem in DeFi, and in some sense all blockchain, is identity or reputation. They're kind of one and the same. But when Adam and I interact via that smart contract, I don't know who he is. I don't care who he is. He either sends the required amount of tokens and it does it or it doesn't. But there's some cases where you need to know somebody. If I go to Desjardins right now and I want a loan because I'm, trying to build something, I want to start a new business, they could look at my reputation and where I went to school and maybe some other things and maybe give me a loan. But if I'm just like a pseudonym, like a masked person, they can't give me that loan. Identity is so important, and in the world of blockchain where everyone is just could be a pseudonymous Ethereum address, how do you give access to these financial products if you can't assess who somebody is? The answer thus far, and all of DeFi, is really built on over-collateralization. So you saw all those loans and trading and borrowing. That means if I give $150 worth of Ether, I could borrow $100 worth of DAI. But what about the person that doesn't have $150 worth of Ether, right? We're trying to bank the unbanked. For the farmer in a third world country, over-collateralizing their CDP, their loan with Ether, isn't a really cool thing. They're like, first of all, what the hell is that? And I don't have $150. I need just $15 right now so I could buy a plow so I could earn money for my family. But I'm like, hey, I don't know who you are. I don't know your identity. I don't know your reputation. So over-collateralization is cool, and it allows for speculation, but it's not really, it's not solving the big, lofty goals right now. And just the final obstacles here, we have smart contract risk, which could be insured against, and there's some cool insurance schemes happening. Privacy, scalability, and slow transaction finality. And this will lead very well to, after the break, exactly what we're talking about. But these are more technical risks, privacy and scalability. And we'll see how Loopring itself is solving them. But that's kind of the end of DeFi right now. Oh, and then we can have a break.
Have a break?
Yes.
All right. Thank you very much, Matthew.
Thank you, guys. Thank you.
Well.
Thanks.
Nice.
So we'll take 10 minutes, 10 or 15 minutes, eat, drink, refill. Battery will go downstairs, follow security there, okay? And then we're gonna go on Loopring.
Yeah, it's a quick.
And Rampage Q&A.
Yeah.
And we're gonna have a beautiful night.
Yes.
So see you later, guys.
Thank you.
And David is the friend you want to have.
Okay, so we spoke a lot about Ethereum and DeFi and a lot of this trustless exchanging. One of the biggest problems, or the scariest problem of exchanging crypto is you give it to a company that has these order books and other traders to trade with, and you don't know what that company is going to do with it. We gave these examples, but just to reiterate, they could run away, they could be attacked by a hacker, because maybe the exchange doesn't have great security, so a hacker steals their, attacks them to try to steal their funds, or a regulator could come in and say, hey, you've been operating illegally, your funds are frozen, all these things. And as I think you guys have an appreciation for now, all of this is about not trusting people with your money or with your executing transactions. We have the technology, the blockchain, to trade non-custodially or self-custodially, where I am the only person that has my funds, and then I give it to the Ethereum blockchain to execute. So why do we keep going to these exchanges? Like, do some of you trade on centralized exchanges? Like, which examples, if you could throw them out? Oh, you're a risky trader. Like 100x leverage?
No, 5x max.
Oh, wow. Too crazy for me. Well, one more example, maybe? Kraken. Yeah, okay. So
Low fees.
Low fees, yeah, right. So those are two big, trustworthy or notable exchanges, but as you know, when you send them your Bitcoin to trade or your Ether, it is in their warehouse now. It's on their server. And as we mentioned with the bank example, while I don't think BitMEX or Kraken is going to run away with my funds because they have reputation and business risk, right? They're making lots of money. They don't want to run away with it. So that's one kind of check mark. Maybe a sketchy exchange, it's like thatguysexchange.com. If you send it to him, he could run away with it because nobody knows him. He's like, oh, great, I have like $1 million. That's enough for me. I'm out. But Quadriga, yeah, great example. And that was a pretty big Canadian one. And the guy, I don't know what happened. We won't even get into that now. But, so Kraken and BitMEX are not going to run away with your money, but they could be hacked. Every day, every second of every day, there's some people that say, wow, there's billions of dollars in Bitcoin and Ether and all these tokens on Kraken and BitMEX. I want to get into their wallets. I want to hack it. You have really smart people trying to drain those funds. We call them honeypots. Exchanges are honeypots because they're the biggest single pots of crypto. They're the best target. So why are we trusting them when we have the technology to kind of obviate them and go around them with the actual blockchain technology? So that is what a decentralized exchange is all about. Whoops. Why does that keep happening? All right.
That's a funny loop.
Yeah, all right. So decentralized exchange, they're trustless, they're transparent. We know all this now. The problem is trading on a blockchain is not that fun or not that great of an experience because blockchains are slow and expensive. And that's by design. I don't mean that as a bad thing. They're slow and expensive because remember the great properties that we mentioned at the beginning. Censorship resistance and immutable and a government can't kill them and nobody could mess with it. That comes at a cost of not being the fastest thing in the world. So to me, often you probably hear about new blockchains or new technology say, oh, Ethereum is 15 transactions per second. This one is 10,000. It's an Ethereum killer. That's the term that everyone calls it, Ethereum killer. But they're making sacrifices on the censorship resistance front. To get to 10,000 transactions per second, they're maybe only having like 10 people validate the network. So while it's not one person, it's 10 people. And 10 people is not that hard to corrupt. We're 5 times that right now. Imagine we are the validators of our new chain, of crypto in Montreal chain, and all of a sudden we're popular, we have a lot of value running through us. We're saying, hey guys, let's get together and start acting in our best interest. So incorruptibility and immutability are at odds with high performance and cheap, fast transactions. And Ethereum really takes to heart decentralization and this immutability and this, this very trusted execution environment. So how could we build exchanges where you need fast, cheap transactions on top of it? And that's what Loopring concerns itself with. So Loopring is a decentralized exchange protocol. We sit a layer above Ethereum. We're a bunch of smart contracts. Remember the smart contracts I mentioned? We're a bunch of smart contracts that depict or describe how tokens could be traded on Ethereum in a trustless way. And we just provide the code. It's there. It's open source. Anybody could check it out. And anybody could take that code to build their own exchange on top. That's what Loopring is. We're not a singular exchange. You don't go to loopring.com or .org to trade. developers look at Loopring's code and say, I am going to build my non-custodial trustless exchange on your code, on the Loopring code. So that's what Loopring does. And just a bit of background on the actual company. We've been around pretty much exactly 2 years, August 2017. We're based in Shanghai. I'm here in Montreal, but about 15, 17 of us are in Shanghai, a few in Shenzhen, a few in Hong Kong, one in Belgium, one in San Jose, and sometimes some in New York. But yes, that's the team, a distributed team, mostly engineers. So we have like really some of the best engineers in the space. Then there's me. Yeah, and we've been concerned with how to facilitate the exchange of assets on top of Ethereum in a trustless manner. That's what we do. When we started, so before I go to this actually for 1 second, when we started building in 2017, we were only able to facilitate 2 to 3 transactions per second. That's the throughput constraint that Ethereum, that was the ceiling on our performance. Now, what I'm going to describe to you today is version 3, the third iteration of the Loopring protocol, where we could have massive scalability and reduced cost as a consequence of that. So just briefly to talk about the different types of exchanges, and again, some of this is a bit advanced, so I won't get into it, but I'm happy to speak about this after. So there's bonding curve based ones, or just, I call that like a token store. Remember I showed you Uniswap in the other presentation. I just put in, I want to sell 0.01 Ether, and it showed me I'm going to get 55 LRC. It showed me. I didn't ask for any type of exchange rate or price. I just said, what could I get for this? And it showed me. That's because it's a fixed function. A bonding curve, really the best way to describe it, it's a token store. You go to the store, you say, how much for this? And they say, this is the price, take it or leave it. That is that model. And that's been quite popular, especially Uniswap, because it's simple. I want to trade Ether for any token. I put it in, and in 15 seconds, I'm done.
You said it was like Uniswap is just like a contract, and you can't change it. Well, how does it determine what the price is?
Right, so very good question. There's a mathematical formula, which is the bonding curve itself. It's literally a curve. It's a function, the curve, that says what the price is. Now, you could have different types of bonding curves. In Uniswap's case, it has this very elegant, simple one called a constant product market making function, or a constant product function. It derives price always the same way by just looking in the contract. It says how much Ether is in it, how much LRC is in it, in this case. Like each pair is a different market, let's say. And depending on the ratio of how much Ether versus LRC, that is the exchange rate at that point in time. Does that kind of make sense? So you have like Ether over LRC, and that product of those two variables is the exchange rate that it would feed me. And the more I, let's say, interact with one side of the market, like let's say I'm a big LRC buyer, so I'm buying LRC, it's going to shift along the curve to make it more expensive, so it's always following this constant product formula that looks at the ratio of the two assets. So there's no room for negotiation. It's just how much is locked up in the contract, and it follows that curve. We could dive into that a lot later, or I could, the founder just did a cool podcast that describes it. I could show it to you. Please.
So the exchange rate is agreed in real time. It's not fixed as part of the contract, the exchange rate.
So the formula is fixed. It's literally like, I forget the notation they use, but it's like K equals Y times X. That's it. That is the formula. Depending on how much Y and X is in that specific pair, your K is different. But the formula is known, but the exchange rate depends on how much. So let's say I come just before you and I buy some LRC, and then you come just after me, it's going to be slightly more expensive for you to buy that LRC because it moved along the curve. And the same thing going the other way.
My concern was that in the process of finalizing the contract, someone could step in and manipulate the price in order to use the smart conscious advantage. What you're saying is impossible.
Right, okay.
You have to have a very fine time skill.
So there are some like attack vectors here. Like there's some front running potential things like there are some attack vectors. It's kind of beyond the scope of this, but suffice to say that it actually is very predictable that I could mess. Let's say I want to mess with you, and I know you're about to buy some LRC for Ether. I could step in, buy a whole bunch of LRC, and it will, for sure, move the price in a way that is, against you.
I see, okay.
And I know you're going to be worse off. So that exists. But keep in mind, that costs me money to do that trade. There's always, like, in blockchains in general, there's always, like, attack vectors, but there's an economic cost for it. It's like, I could mess with you, but it's going to cost me money. I'm going to push the price out of equilibrium, or I'm going to, in this case, but yeah, so I could mess with you, but it's not like I'm going to be off scot-free. And look, to be honest, I'm not an expert in bonding curves. You'll see that Loopring is a different sort, but this is just the most simple way. It is like a token store model, and as you said, it's the formula is there, and these have really taken off in popularity because of the simplicity. This is almost similar to this, but instead of a bonding curve function that is, very predictably saying the price, this is like, instead of that curve, you have a few market makers, you have a few companies or guys, girls, whose business it is that when somebody says, hey, I want to trade this for that, they look at their inventory and they say, okay, this is my price. And they're constantly like pushing prices out there for you. You ask, here it is, here it is. Of course, like they're not doing it manually, it's like programmatically through their API. But Kyber is also a very cool and very popular on-chain thing, and it's equally quick. It's still like a token store type feeling. It's a swap. It's a real swap. I say, hey, I want to sell some Ether for LRC, and behind the scenes, somebody is giving me a quote, a market maker. That's their job to do. So these are kind of what's been very popular right now. Then there's auction-based ones. Have you guys heard of Dutch auctions? In certain things, and where when there's like an art piece for sale, and there's like reverse auctions, or the way you could auction an old car, or what's that?
IPOs too.
Yeah, IPOs. Yeah, Google did a Dutch auction back in the day, stuff like that. Then there's derivatives. We spoke about that kind of in DeFi. Then there's order-based, and this is where Loopring comes in. And our closest kind of peer is 0x, which many of you may have heard of. They're a very interesting protocol, most similar to us. Order-based, this is what you guys are most familiar with, I'd say, when you see like the stock market, or when the way normal exchanges work. You say, I want to buy a share of Apple for this price, and you submit your order. Right? And then it goes on an order book. That's how BitMEX works, that's how Kraken works. Right? Like centralized exchanges that we all know in crypto, you guys are familiar, like you know what an order book looks like? You have like a bunch of buys and a bunch of sells, and like in the middle is where the action happens. It's like when the buys and sells overlap. This is how the majority of the world's assets trade, at least in equities, for sure in equities, because people have more granular control of their price. And really, the people that trade the most assets are large institutions, hedge funds, sovereign funds, pension funds. They are price sensitive. They don't want to go to a bonding curve and say, what price can you give me? Or a quote-based thing. Although they could, or auctions. They say, I want to sell $100 million of this at this price. And their orders on the books. So that's what Loopring. So now we just learned all the different exchange. Is that clear to everybody? Okay, because it could be.
Personally, I believe in like each protocol there has a certain functions that will fit in. Like I could use like the auction base for IPO or something like that, and it would be really good.
Absolutely. They're complementary. Like, I definitely agree. Auctions, like we kind of skipped over that, but those are good for price discovery. It's like nobody knows what the price of this clicker is, so like I put it up for auction, and then like I let the crowd decide. I might be completely off base if I'm just like, all right, this clicker for $10,000, right? It's like, I don't know, I need to let the auction decide. So you're absolutely right. They're complementary, different. They shine in different lights. Okay, so 3 generations of DEX tech, and I'll go over this quickly. We have the blockchain, the monolithic Ethereum blockchain here. The most naive implementation of a DEX, and I don't mean like naive in a bad way, but just like the kind of first iteration, everything on chain. You place an order on chain, you cancel an order on chain, it gets matched on chain, everything happens on chain, settlement. But we just said that blockchains are expensive and slow on purpose. They're hard to mess with, so they give up they're slow and expensive. So doing this costs money. Remember, you have to pay gas to execute transactions on the Ethereum blockchain. So when I place an order and it goes on chain, I'm paying 15 cents, let's say. I want to cancel it, 15 cents. It gets matched, all these things, they cost money, and it's not great. We're never going to conquer the world. Because remember, when you're on BitMEX or Kraken, when you place an order, it's free because you're not speaking to the blockchain. You're speaking to Kraken server that says, that's an order. Oh, I take it back. I cancel it. Oh, I take it. It's free. We're just using the legacy tech. The blockchain doesn't get involved at all, right? That's a benefit that you could trade very cheaply and quickly on Kraken, but that's because you're trusting them that they will be faithful in the execution and stuff. So here's the exact opposite. Everything is slow and expensive. Oh yeah, by the way, I was just saying that costs 15 cents. It also takes 15 seconds on average to even get that. I place a trade to show up in the order book, it takes 15 seconds. Imagine how annoying that is for these professional traders, all these time delays. It's infeasible. So I'll go on here, but so the characteristics, it's as secure as Ethereum, but the throughput is very, very low, less than 1 transaction per second, high latency, that means it's very slow, 15 seconds, and it's very costly. So we've seen those, but they're not going to, really take over the world. Then there's settlement on chain. And this is how Loopring 1.0 started. We said, let's do everything off chain. Like I'll send an order to like an off chain order book, like Kraken or BitMEX. You could match it, you could cancel it, or the cancellation is a bit of a nuanced thing, but we'll do a whole bunch of things off-chain, and let's only use Ethereum for the most mission-critical component, which is the actual settlement. Remember we said, I don't want Adam to run away with my money, we don't want to trust an intermediary. We put like the matched transaction on Ethereum with instructions to the Ethereum chain that says, swap our tokens at this ratio, and it does that. And that's a pretty good implementation. That's what we built. It's still as secure as Ethereum, because even though we're doing some things off-chain, in like just on servers and stuff, I never gave control of my assets to that order book, to that DEX. It's not like Kraken or BitMEX where I gave them my assets. I still hold my assets. I just said, hey, here's my asset. I want to trade it at this exchange rate, and here's my proof that I have my asset. Like I'll sign something cryptographically. Now, if you find a match, if you submit it to the Ethereum chain, my asset will automatically flow out of my wallet, and I'll get the corresponding one. So that was good. Again, as secure as Ethereum. Throughput was still very low, 2 or 3 transactions per second. High latency still, very slow. And it was cheaper, but still costly. Now, okay, here's where we get to the exciting things, and I'll speed it up here. And just to kind of remind you of what we just heard as an example of zero-knowledge proofs. So I'll go back here so it doesn't distract anybody. Zero-knowledge proofs are this really mind-bending cryptographic tool that have been around before blockchains. They're just a cryptographic tool from the 80s, early 80s, and as he alluded to, they prove something in zero knowledge. So the name is kind of explanatory, but it doesn't illustrate it that well. Zero knowledge proofs. It basically says, hey, I have something in my hand. I have a gold coin. I don't want to show it to you for whatever reason, because then maybe I'm scared that you'll take it out of my hand. I don't want to show it to you, but I have something in my hand, or I know some secret, and I'm telling you I know it, but I'm not going to divulge exactly how. Instead, I could use this really crazy mathematics, and I don't want to try to just keep saying crazy and how it's mind-bending math, but really it's way over my head. And it's really cool stuff. But these zero knowledge proofs, basically I put in some inputs into this circuit, this prover that says yes, and it either outputs, to simplify, true or false. Yes, Matthew does have this thing in his hand, or he knows this secret. It's true or it's false. And you could trust that proof as much as if you actually saw what's in my hand. I can't tell you why, but by the properties of math, this proof is as good as seeing the thing itself. So instead of me showing you the thing or exposing the secret, I give you this proof, and you could take my word for it with as much fidelity as you did if you saw the thing itself.
By induction, in other words. You're proving a small piece of the pie and showing that it applies to you.
Yeah, that's fair. That's fair to say.
So with the driver's license, there's a bunch of information on it that the person at the liquor store doesn't need to know.
Yeah.
So without showing the driver's license, you can have true or false that says that I am the right age, or I am over the age of 21 or 18.
That's a very good example.
Exactly right. That's a big use case of it. Exactly right. It's like selective disclosure.
Right.
Why do they need to know my street address and everything? They just need to know if I'm over 21 or over 18.
Yeah.
That's a big thing. A similar use case is like, let's say I go to Desjardins private wealth, division. They only take people with over $10 million. I don't want to show them that I have $1 billion, but I still surpass the threshold. So I say, hey, here's a proof. I have 10 million. Oh, I have greater than 10 million, but you don't know how much I have. Anything like that is, you could prove things exactly like that. So just before we go on, what's been really cool about these zero knowledge proofs, they've mostly been associated with privacy related things. It kind of relates to what we were just talking about, keeping some things private. But there's some coins like Zcash. Maybe you guys have heard of Zcash, which are pioneers in zero knowledge proofs. They have used zero knowledge proofs to give for privacy coins, for privacy preserving attributes of coins. Because right now, by the way, when I send you a Bitcoin or you an Ether, my address and your address and the amount is completely visible for everybody to see. That is how this whole thing works, is because it's verifiable by anybody. I don't know, nobody knows that I am that pseudonymous address unless I de-anonymize myself by posting it on Facebook or something similar to you. But once somebody once they connect the dots, the transaction is very visible for everybody to see. So Zcash and a lot of other cool projects, they use zero knowledge proofs to obfuscate these details. So who the sender is, who the recipient is, and the amount could be hidden, but we still could take we still know that the transaction happened. Even though it's like blank amount, and blank, it's still verifiable. So it's really cool things, and privacy is a super important property of money. Not to dive down this rabbit hole, but money needs to be private, because if everybody in your life knew every transaction that you made, it's just not good, right? Whether it's your spouse or your employer, maybe you have some, whatever, okay? Yeah.
Also, fungibility?
Exactly. So for money to be fungible, it has to be private. Meaning, if I spend this with a nefarious person, whatever my vice is, if this dollar gets X'd and it carries that X forever, then it is likely worth less than $1 to the next person. It is It's tainted. It's no longer fungible. Fungible means that like you don't care between this loonie and this loonie and this loonie. They're all fungible. I could shuffle them out and you'll take any of them. But if one of them is like, oh, that's the bad loonie because he gave that to you know who, then it's not good. So zero-knowledge proofs are really cool for privacy, but you know what? They're also really good for scalability. They're actually good at proving that besides preserving privacy, they could say, hey, so remember, I had a secret in my hand before that I said, yep, he has it. You don't have to expose it. What if I said, I am going to perform a bunch of exchange-related transactions. Matthew deposits, he makes a trade, he gets matched, he fills it, then he does another trade, then Adam does a trade. All these things, and I'm going to put it into that same like prover, that same circuit that outputs true or false. So all the intermediary kind of like nitty-gritty stuff doesn't matter. All that needs to happen is like, did all of it happen, yes or no? Yes. You get a proof which is much smaller than if you had to prove all the intermediate steps. You just get a proof that says, yep, that all happened, and you put that on the blockchain. And that is very small. Imagine like 10,000 things could go on, and you get one small proof for it, and you only put that on the blockchain. But it's as good as if you put everything on the blockchain. So that is really what is so incredible about zero-knowledge proofs for scaling Ethereum. And that is what Loopring is using to scale the third version of our protocol, by just submitting proofs, not all the messy details. So as we see here, like the proofs are small. They're 32 bytes and 256 bytes for the actual, the snark proof. So the type of zero-knowledge technology we use is called ZK snarks, which stands for Succinct Non-Interactive Arguments of Knowledge. That doesn't matter that much, but the cool thing about that is like non-interactive means you don't need to like interact with the other person to prove that you know that secret. It's non-interactive. It's like, here's the proof. Yep, there it is. There's no like back and forth, just to kind of simplify it. But so this is how Loopring is scaling version 3. We've been working on this for almost a year. It's in beta, like private beta. We have a bug for all the developers out there. If you guys know this stuff well, so it's like we have a bug bounty to verify our smart contracts right now. So if you're a Solidity developer, we have about $50,000 worth of bounties for anybody that could find a critical vulnerability in our scheme for version 3. That's on Gitcoin. It's also on our blog. I won't dive into this too much, but remember, all those nitty-gritty details that I described, I said that we don't put them on the blockchain. We do them elsewhere. We do them in a Merkle tree. And as many of you will know, Merkle trees are just a data structure with some interesting properties where I could change a whole... So remember, this will be like, okay, Matthew's account, and like he deposits, he withdraws, he trades again, he cancels, he trades. All of this is like happening. And then I just have like the Merkle root, which is kind of summarizing all of the lower level transactions. And the Merkle root is what's important here. So I submit the Merkle root, I submit the proof, and that's how Loopring 3.0 works. So for on-chain transactions, there is a requirement for an on-chain transaction at the beginning. You have to deposit into this Merkle tree at the beginning. That's kind of like one give up that we have to do. For all the great properties, we have to do an extra transaction at the beginning to allow this. So here are the characteristics. It's as secure as Ethereum. Remember, I said it's easy to get performance benefits if you're going to sacrifice your like real principles of, censorship resistance and security. We could do everything in a BitMEX or Kraken style exchange, and then we'll be as fast as anything. But you got to stay as secure as Ethereum. The throughput is very high, 660 transactions per second. Remember what the other one was. It was 2 or 3. So this is 300x improvement. Like really, really significant. 300 300 transactions per second, very low latency. We don't actually have to wait for an Ethereum block settlement time, for like a block cycle. It's instant, more or less. It's less costly and it's quick finality. When I make that trade, it's very fast. So it's like I could approximate the feeling of a BitMEX and a Kraken, but with the security of Ethereum. That's the holy grail. I want to feel like I'm trading on a centralized exchange, but with the security of Ethereum. And that's what we really go for. So these are kind of the advances that Loopring has developed throughout the versions. And scalability is really the name of the game in version 3. Staking has to do with our token, which I could get into a bit after, but it adds some extra security. But here we go. This nicely summarizes the performance. So with Loopring 2.0, 2 to 3 trades per second, 19 cents per settlement. That's a lot. Here, there's 2 types of Loopring 3.0, and I'll get into that like just really briefly. But in the best case, we have 660, and actually, I added this here. As of 2 days ago, we implemented something that got us all the way to 5,200 trades per second, which is really crazy. We basically switched the hashing function from something called MIMC to Poseidon, and this is just a much more zero-knowledge proof, or it's a much more ZK snark-friendly hashing function. So we're going all the way up to 5,200 trades per second. Remember, we were just here a couple months ago, so massive improvements. We're really excited by it. For the first time, we feel like we could compete with the centralized exchanges. It's no longer, okay, I'm going on Kraken because all DEXs are so slow and costly. No, we could do this for less than 1 penny per settlement. So really exciting. Just to kind of expand on what these 2 differences are. Remember I said all the nitty-gritty intermediate steps are like just in a proof, and that proof is on chain? There is a risk that the DEX operator, the DEX where you're trading, says, hey, I'm going offline. Like maybe they literally just like stop responding to the API calls. They leave. Your money is still safe because remember, you never gave it to them, but it's in a smart contract. But you need to be able to reconstruct history to some point in time. You want to say, hey, I had $1 million a week ago, and I could prove it because here, look at the state of my account in that Merkle tree, let's say. But where is that Merkle tree held? If you hold all that intermediate data on-chain, so that's on-chain data availability, that's using Ethereum itself, which is obviously this like eminently available system. If you use that, then you could only do 200 trades per second because you're actually packing in more info. And remember, the information and the storage, it's costly and it's slow. So that's why with on-chain data availability, which is like the most secure, we could still do 200. It's 100x more, but it's not as good as this. Without on-chain data availability, that means you just put the proof on-chain, but the Merkle tree is kept elsewhere, some other scheme, nothing to do with blockchain, let's say. Maybe you give it to Desjardins, who keeps the state of the Merkle tree, because that's not as mission critical as the actual exchange itself. They just keep this state of affairs, which anybody could kind of go to in the archives and be like, oh yeah, look, at this point in time, I had this much money. So that's kind of just the difference of data availability. Is your data available on Ethereum itself, which is the best, or is it available elsewhere in some type of separate scheme? So that's where we're at. Those are the amount of trades per day we could do with and without on-chain data availability. Remember, if we use Ethereum for the data availability, it's just we're slightly more constrained. Moving on. Okay, so this compares, maybe you guys have heard of Starkware, StarkDex. They're some real great pioneers in zero-knowledge technology based out of Israel. They're kind of our closest competitor or peer right now. They're using something called Starks. We use something called Snarks. Some slight differences. Snarks are kind of like more understood and more used and like thoroughly tested. Starks are more experimental, but they have some potential benefits. There's trade-offs. Like everything else, there's trade-offs. And you see here, we're really excited by this. For the first time, we think that exchanges will be built on us that could compete with the big centralized exchanges, which is really, the philosophy of the whole space is to allow this. Here we look at some differences between snarks and starks. I won't get into this now, but basically there's some trade-offs between like snarks could be generated in different times versus proven and verified in different times, and they have different sizes. Not worth getting into now. Here's our roadmap. So we have the internal beta coming out in August. Then we'll have an invitation-only beta. I won't push this too hard right now. And then we hope to be public by the end of this year with data availability, so the most secure solution. And that's it. So what we've learned, dApps, all those DeFi applications we mentioned, we need to find a way to scale them. And zero-knowledge proofs are a very promising angle. That's what I just said. Zero-knowledge proof is a really good scaling solution, and that's along with its privacy-preserving properties. Scalability versus security, that's the theme we've been speaking about this little chat. DEXs will prevail soon, we believe. And interoperability, remember, everything we're talking about here is really Ethereum-based. If we want to interact with Bitcoin, that requires a different set of considerations, which I'm happy to discuss after the fact. I won't get into it now. But that's it, guys. Thank you so much for bearing with me.
All right. Thank you. Very good. Good stuff. I'm really impressed. I guess we have many questions, guys. Just for the camera and the lifetime of those videos, I'm going to ask everyone, please just stand up. We're going to put the mic here and just go ad lib and let's do it. So who has a question?
Hey, thanks for the presentation. It was good. I had a question about the latency. How is it that you're able to get such low latency if you need to wait for a transaction to be hosted?
Right. So that's a very good question. The reason why we could have like that near instant finality in version 3 is because we actually don't need to submit to the Ethereum chain right away. It could approximate like a centralized exchange experience because when you execute, what you're really doing is updating the Merkle tree.
Yeah, so you settle it on your own, you don't have to worry about double spending because you have to work on it.
Right, so the Merkle tree is changing, and then a DEX, really what they're doing is like they're updating the Merkle tree, their data structure with everybody's balances. That's like the history of the exchange. And then every so often, they are sending all this batch of transactions to what's known as the operator, which is like the zero-knowledge prover. The prover then takes this batch of 10,000 things, generates this, right, the snark, the cool proof, and that could happen in parallel. So it's like you send it transactions, and it's very like GPU intensive. Like you have like parallelized GPUs that are running these computations, and then it gets another set, and it starts doing it. You don't need to submit the proof on-chain immediately to Ethereum, but you do have a fixed amount of time to do it. When you create a trade, the operator must submit the proof within, I actually don't know the exact time, let's call it 100 blocks. If it doesn't submit the proof, the DEX will be punished. They'll be slashed. That's where the LRC staking comes in. The same way that Ethereum is moving to proof of stake and that people that misbehave will be slashed, their stake. If a DEX, one of the bad things a DEX could do is like be slow to submit their proof. The operator will be slow. It's like you better submit it by 150 blocks to kind of give that last final bit of verification. Otherwise, you're going to be slashed. So that's a new use case.
One more follow-up. Then, so if you give a confirmation of the trade, it's such low latency, but can you actually exchange the tokens then?
Right. So it's kind of similar to what we just said. Right. So really what we call it is apparent immediate finality. Like it's apparent immediate finality to you. Right. Behind the scenes, they can't steal your money, right? We're still nowhere near the centralized exchange risk profile. But yes, you don't have that like final stamp of like set in stone that the proof is submitted to the Ethereum blockchain. But you do have a proof that the Merkle tree is updated, the operator is running it. And by the way, if something is wrong in there, then the proof won't work out. Remember, it's either like true or, so yeah, you're absolutely right.
Something else?
So if the operator takes the opposite side on the trades and they lose, but then if they get slashed, it's less than they're losing, wouldn't it be worth it to just not publish to the chain?
Right, so...
I guess they get penalized for not publishing, right? Which is what makes the transaction final.
Right, they get penalized for not, but they cannot make up history. They can't just like arbitrarily steal your money or like change the exchange rate to something crazy, because still, when you this is still using like the primitives of like you signing an order that is just, what's your name again? I'm sorry? Chris. It still says Chris wants to sell 1 ETH for 5,000 LRC, and here is my signature, my account's signature. I cannot falsely, as the exchange, say, oh, actually it was 1,000 ETH. I can't do that, because your signature will not verify.
Let's imagine I'm doing a trade, and then the trade moves in my favor, not in my favor, by like 10 million within that time frame, and if I get slashed, I'm only losing like, I don't know, whatever, 1 million, then I'll just pretend the trade didn't happen.
Right. Okay, I see what you're saying. That's a very good point, and these are like the nuances of like economic design here. The first thing is, if the situation is on-chain data availability, where every intermediate state transition is published to the Ethereum blockchain, then you cannot mess with me, because I could always reconstruct the Merkle tree from the most highly available data source in the world, Ethereum. If that Merkle tree is kept off-chain to allow for that extra throughput, then there is indeed a way where you could withhold it. You're like, hey, could I have the Merkle tree reconstructed from like 10 minutes ago? And the DEX is like, no. And that's when these secondary means come to it, like the slash. We do impose like some minimum LRC to be staked, things like that. But you're right, there might be a tip-off point where there is something. But nonetheless, you can never steal the money still. You could like withhold it from me, and as you said, like you don't want to execute the trade because it went away from you, but there's still, I have some minimum guarantees. But honestly, this is like getting into the weeds where our engineers would have probably much better answers, but that data availability difference is a crucial difference here. But that's a very good question, and maybe you should work on our bug bounty.
I have one for you. About this Merkle tree, sounds a bit magical because of the power of the zero snark function. How do I know that the Merkle tree was not tempered, whatever it is in, I would say, AWS database? I guess there's some Explorer for that, I guess.
Right.
So how do I know that the Explorer I'm looking at,
right,
which is kind of centralized on that server, that those R drive, I should say, how do I know?
Right.
This isn't a good one.
Yeah, that's a very good question. We will actually have to build, like, the same way there's like Ethereum block explorers, we will have to build like Loopring pseudo block explorers, because all those little transactions should be able to be, parsed through. So the fact that you use that word, yeah, we will have to build that. The Merkle tree actually has nothing to do, like the Merkle tree itself doesn't have anything to do with the zero knowledge stuff. We kind of like snarkify the Merkle tree, but like the Merkle tree could exist on its own without zero knowledge proofs. Like Merkle trees are used everywhere in Ethereum and cryptography and stuff like that, but I cannot fake an update to the Merkle tree, because it needs, as we kind of looked at it, only I could change that thing. Like my account, like this is Matthew, this is my public key, this is my balance for, like the construction of the Merkle tree, by the way, is a very complicated thing. And the way we had to optimize it was like a huge internal success of like how we differentiate from other projects. Like, because updating a Merkle tree, like it costs, like on Ethereum, it's like how do you do it in the least expensive way and the quickest way? But you can't fabricate history here. You can't say that like Matthew tried to send this stupid transaction because it just won't work. My signature won't be attached. The same way that if like on Ethereum itself, if I were to say, oh, hey, you just sent me 1 million ETH, it's like, no, you can't fake that. You need my signature. My private key, well, there's actually a separate type of trading key, but the point, it's a good question. You cannot kind of fabricate history. You can't do that. You could like withhold data in some cases, but by the way, the same way that BitMEX and Kraken are operating faithfully because it's good business to do so, the DEX that's built above here, let's call it MatthewsExchange.com. It's just a new business, and our value proposition is don't ever trust me, everything is so trustless. If I do start acting nefariously, you will just take your business elsewhere. So there's always that fallback. Of course, I don't say that is the Loopring fallback, but even if you start saying, if I don't start giving you data when you ask for it, then you're going to go elsewhere. But keep in mind, I can never steal your funds.
All right, just yes or no, and I'm going to read to you. In a case we need to go to a judge, can we deconstruct in front of the judge the transaction?
Right. So the judge in this case is just a past state of the Merkle tree. It's like so in the data availability case, I will always have each state transition. That is the judge and jury. Like that's it. In the off-chain data availability, again, you could withhold the data and say, oh, I don't have this from 2 minutes ago. All I have is this from 20 minutes ago. And that has like nothing to do with actually the protocol itself or the blockchain. How you want to keep the Merkle tree is up to you in the non-data availability case. But yeah, the judge in this case is just, so one of the Loopring protocol smart contracts is just, it's the verifier. It's the thing that looks at the proof and says, yep, that's a valid proof. That is the judge. That's the ultimate judge.
I should have said if we need to go to the court, the real court.
Oh!
Sorry for that.
Sorry.
Is not that
I don't
good,
think
so.
in the real world anymore. Sorry.
So could you deconstruct what happened? That's my question, yes or no?
Right.
So.
That's
because I think this is the ultimate point.
I feel like this is like probably some of the strongest proof ever presented to a judge. It's like this is just cryptography that like secures everything like in our world. Look, I have this proof that like this state of the world existed. If you have that proof, then I feel like that's very submissible. Then again, don't take whatever I just said. I don't know.
Yes. We could deconstruct that.
You could reconstruct the Merkle tree.
I should say reconstruct, yes.
Yes,
okay.
Yes.
Good.
Great presentation. Would Matthew's DEX be able to front run my order? Would they see it before everyone else?
Yeah, good question. The DEX itself could, they think you just put like a good order that they want to take, they could take that before another person. They could do that. We are not, there's that level of trust. Like in the grand scheme of things, in all the ways that like somebody could act adversarially against you, the one we're most concerned with is them not stealing your money and your money always being yours, them kind of picking you off trades. I'd say that it's not fully fleshed out exactly how because we had dual authoring in previous versions, but I think ultimately if a DEX wanted to take your order instead of like that other person's order that should have matched with you, I think they could do that. I don't know if that's a solvable problem.
I got a question. It's just, did you use like circuit breaker?
Oh, like if things go wrong. Yeah, very good question. And I actually should have brought this up in terms of some of the other questions. But yeah, there is something called shutdown mode. And shutdown mode is like irreversible. And it's like if you don't submit the proof or like you're withholding data, after a certain time, you enter shutdown mode automatically. And the only thing it's like you're incapacitated as the DEX. You can't receive transactions. You can't match transactions. All that's able to happen is that your clients could withdraw money from their accounts on your exchange. So it's like you're tied up, you're shut down, and that's like irreversible. You're out of business. So that's like the circuit breaker. That's like the big fail-safe. Shutdown mode, it's like you're gone.
So you went to one point to the extreme other point. Like usually like circuit breaker out like mini.
Okay, fair. Sorry, yeah, I went to the extreme. There is, we don't call it a circuit breaker. We do have something called maintenance mode, where if you want to so it's a very good question. If you want to like upgrade a certain part of your system, the system that lives not on the blockchain. Remember, because still you're like hosting an order book on like legacy tech, right? It's like that's your matching engine, 10 million transactions per second. If you want to upgrade that, you could buy maintenance mode time. You basically tell the smart contracts, say, hey, what's your name again? Bruno, yes. Bruno's DEX wants to upgrade its system. Give me 24 hours where you can't send me transactions. So that's, I don't know if you call that a circuit breaker, but we call that maintenance mode, where you're able to like say, hey guys, I'm not going to, because remember, if I do send you transactions and you match them but fail to submit the proof, you're going to be penalized. So you need a kind of breather. You need to be able to do something without some heavy repercussions. So that's a very good question.
I have another one about the 1 cent fee. So it sounds like you're not taking a percentage of the transaction, but just like a fixed amount. Is that right?
Right. So good question. The 1 cent fee, first of all, keep in mind that it has to do with like the gas cost. So here we're doing ETH 275. It's, I guess, a couple of weeks old now. That's how much a transaction would cost. In there's two components. There's the gas. So first, who's paying this fee is the actual exchange, because they're the ones that submits the proof to the Ethereum blockchain. They could, of course, charge you 20 basis points, 0.2%. That is like a business decision. This is like the technical layer. How much does it cost to settle a transaction to Ethereum? 1 cent. In all likelihood, Matthew's exchange is going to be paying approximately 1 penny to the Ethereum chain for its security and for all that. But I may charge you, Pascal, 0.5% per trade. That's a business decision for me. Nothing to do with the actual blockchain. But this is just how much does it cost to send this proof to the chain. Also, in here, there's another cost, which is, there's two costs, like Ethereum gas plus the off-chain part, the proving. Remember, you take a bunch of transactions, you give them to a prover, that costs money. It's like some GPU-intensive things. That is like the ZK snark prover. That's actually something that Loopring is going to operate as a service to some DEXs who don't have the competency to do that themselves. But this is like the all-in cost to settle a transaction.
All right. Makes sense.
That's a good question.
Other question, guys? That's it. I think we got it.
Okay, guys.
Merci beaucoup, Mathieu.
Thank you.
Sorry.
Thanks so much. Good questions. Thank you. Awesome.
Thank
Thanks.
you. All right, guys. Let me end on that. We have meetups every 3 weeks. So that was the 33rd, I'll say it in French. C'était la 33e édition de Crypto Montreal. Donc le prochain, je crois que c'est dans 3 semaines ou 6 semaines, peu importe. Donc allez voir sur Meetup, allez voir sur mon blog pascalindy.com. On fait aussi des meetups d'introduction, des meetups un peu plus avancés comme celui-ci avec Smart Contract. Si jamais vous êtes intéressé de présenter 20 minutes, 1h30, venez me faire signe. David, Tamara sont là aussi pour vous écouter. Donc, je vous remercie beaucoup d'être venus ce soir, puis en souhaitant que vous ayez appris quelque chose. So, Merci beaucoup.
Thank you guys.
Très bientôt.
Thanks.
Ciao, bye.
Thanks a lot.
Juste un qui est là-bas, avec